far from done.
Moment news breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this?
Is Bloomberg Markets with Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Some more data today confirming that inflation is in fact on the decline. What does that mean for the Federal Reserve coming up? We'll break that down. Plus, we have a big tech talk today. We're going to talk about Huawei. They have their 2023 Innovation and IP Forum at their Chinese headquarters. That's today. We've got a couple of the leading executives there at Huawei to join us to talk technology. Let's talk something AI. Is that a thing? We'll talk about that coming up. But first, let's go to Denise Pellegrini and get a Bloomberg Business Flash.
Hey, Paul, we check the markets all day long for you here at Bloomberg. It's 10:01 on Wall Street. We do have a little bit of a rally going on another sign. Inflation is easing. As you mentioned, U.S. producer prices, they rose at the slowest pace in nearly 3 years. The producer price index for final demand rose just 0.1% from a year earlier, according to the Bureau of Labor Statistics. And on a monthly basis, the PPI also increased slightly. But on the other hand, a report on first-time jobless claims showed fewer people than expected filed for claims, and that does show possible continued strength in the labor market. And Torsten Slok, chief economist at Apollo, says the labor market is certainly still flashing warning signs on inflation and the Fed.
So in that sense, there's still a very strong labor market. Average hourly earnings last Friday went up, and this labor market, obviously in jobless claims, still looking relatively tight, which certainly also get the Fed to say, well, we still need to hike rates more, and still tighter monetary policy is needed.
And Slok there on Bloomberg Radio and television. We do have a mini rally going on. Stocks higher. The Dow up 99 points right now. That's about 0.2%. The S&P 500, it is up 24, about 0.5%. The NASDAQ, the big winner once again on the day, up just about 133, 144 points. That's almost 1%. The yield on the 10-year Treasury right now, 3.8%. We also have crude oil falling today. Crude oil right now down. Well, it's a little bit higher right now on NYMEX crude, but it's been lower for most of the day. Gold, spot gold, it is higher. And some strength in the air for airlines. Delta sees global travel pushing summer profit past expectations. Carrier beat earnings expectations. It's raising its full-year guidance. CEO says there will be significant growth in demand. Delta shares soaring on that news. And are you grabbing more snacks lately, Paul? Because PepsiCo
Sure.
boosting its sales and earnings forecast. Are you a Gatorade fan, though?
I'm a monstrous Frito-Lay Fritos fan.
All right, so you're busted here. Yeah, they can thank you up in purchase because it's all seeing strong demand for all of it. Lay's potato chips, Gatorade, Fritos, Mountain Dew. I don't know if you like that one, but all showing resilience, even though they're charging more for it. Consumers, even though the pandemic is over and people aren't sitting at home eating those snacks anymore, they're still buying that stuff. And shares of PepsiCo are also higher. And that is your Bloomberg Business Flash. Paul.
All right, Denise Pellegrini, thank you so much. We appreciate it. Madison Mills, Paul Sweeney here in the Bloomberg Interactive Broker Studio. And, of course, we are streaming on that thing called YouTube. You can just go to YouTube and search Bloomberg Global News, and that'll get you where you need to go. Let's look at these markets here. A nice move, as Denise was just reporting. Nice lift to the marketplace following up on yesterday's gains. Let's break it down with a Bloomberg Equities reporter, Carmen Reinecke. Carmen, what do you got for us?
Yeah, so one of the biggest movers that we're seeing this morning is Viasat, ticker VSAT. It's a satellite communications company, and it's down as much as 36% today. That's on track for a record drop if at the close if this holds. The company said last night that an unexpected event occurred during the deployment for one of its communication shuttles, or satellites, excuse me. So, obviously analysts and investors aren't feeling too good about that. Sort of on the flip side, at least one analyst from William Blair said that this might be largely emotion-driven. There was no change to coverage for customers, and the company's working on a quick fix, and it also has a lot of other satellites sort of in the mix.
Yeah, I've looked at this. I've covered the satellite business in the past. You don't like to see any of these technical glitches here because you just don't know how bad it's going to be. And Raymond James analyst Rick Prentice, who's one of the best in the business, he says, this concerns me. This could be a problem because, this is, as we do more and more stuff online, put more and more stuff into the cloud, you need more broadband coverage.
Well, so do you, Paul, have any insight into what the unexpected event is?
No,
here? Because they're being super cagey. We were talking about this before we were on air. What does that mean?
They're talking about reflector deployments. I'm thinking about some of those, reflectors that, use it for maybe to get solar energy or something like that. So it just, and they deploy over time. And if you have a glitch, it kind of impacts the capability.
Well, and another analyst noted that this particular satellite has already seen a very long road to even being launched into space. It just launched on a SpaceX shuttle at the end of April.
Okay. All right.
So that's certainly disappointing for investors as well. After
it's a high risk sector. It's a high risk. It used to be a lot more much more high risk when the satellite technology and the rockets, when you're shooting them off French Guiana, you could have a lot. This isn't NASA launching satellites, so it can be a little bit risky. Anyway.
Yep.
You know this space, Paul.
It's fun.
You really do.
Well, in other space news, we're also seeing Virgin Galactic up a little bit. It just announced the target date for its second commercial flight. So shares are up a little bit. This will take 3 private passengers into space, and the window will open on August 10th. One thing that's interesting, Virgin Galactic, we always kind of see this kind of price action around it announcing these windows for space flights, but then on the actual launch, at least the last one, we see the shares fall. So this is kind of an interesting, the investors are sort of trading the headline a little bit ahead of what's going on. And then another really interesting one that we're seeing this week, I think everyone's sort of heard about this, is Amazon. Obviously, it had Prime Day wrapped up over the last 2 days. Shares are about 2.5% higher right now. And yesterday it announced that at least its first day of Prime was one of the biggest sales days for it. So that's obviously given some shine to the shares. We've also seen a lot of other retailers kind of jumping in on this trend. So, big box stores, other online retailers have like competing sales that, coincide with Prime Day. So I think that's just a big deal for
Alibaba
the
has singles. Right?
Yeah,
Singles
exactly.
Day.
Yep. 7-Eleven.
Yep.
This is also, it's interesting because in the last 4 years, Prime Day hasn't really been a catalyst for Amazon shares. Usually in the week, of Prime days, it falls. And so this year, it's on track to gain, and it for whatever reason, maybe because it's showing consumer strength or optimism, it is actually giving Amazon shares a lift.
Yeah, we were talking about that on the show earlier this week, just that the stories, particularly with Amazon stock, is about AWS cloud services.
Yeah.
But it's giving a lift to the overall retail sector on the S&P as well. So seeing a lot of strength in the retail space that we haven't seen these past couple of months.
Exactly.
And my household really contributed to that, Carmen. I don't know about you, but it was brutal for me when it came to Amazon Prime shopping.
All right, we got some earnings tomorrow. The big banks report earnings, so that'll be big. And again, I always look forward to listening to and reading the comments of Jamie Dimon, because who's got a better view of the global economy than Jamie Dimon, and he has no filter. He'll say whatever he thinks. So we'll pay attention to those earnings tomorrow.
Yep, exactly.
All right, great. Carmen Reineke, thank you so much for joining us. Carmen, she covers all the equities for Bloomberg News. All right, a lot of economic data to digest this week on the inflation front. And, we've got the CPI yesterday, PPI today. I guess the takeaway for a lot of folks is pretty darn good as it relates to the Federal Reserve. But let's talk to somebody who does this stuff for a living. Jennifer Lee, Senior Economist and Managing Director at BMO Capital Markets. Jennifer, again, a lot of inflation data this week. What is your takeaway?
First of all, good morning, and thanks for having me on. My takeaway is that finally, all of these Fed rate hikes are making an impact on inflation, bringing it down to that, what I used to think was the elusive 2% target is finally starting to happen, back down to a 2-year low for the headline. PPI we saw this morning, I was just glancing at some of the details, but looks pretty good, only up a tenth for both the headline and the core, and down to I think it was like 3-year lows or something for on a year-over-year basis. So again, all those Fed rate hikes are starting to kick in, and we're finally starting to see the fruits of their labor.
We're finally starting to see it, but we are still not at that 2% number. What do you think might be the catalyst to finally get us down to the Fed's desired inflation rate?
I think it will have to take, well, first of all, just in terms of our Fed rate outlook, I mean, we're still looking for that Fed rate hike next, or in 2 weeks, I guess, on July 26th. Even though we're seeing this, promising inflation data, the fact that wages are still running pretty hot, job demand is still pretty strong, housing has already found a footing, business investment is decent, consumer spending took a little bit of breather last month, but the month before that they're running hot as well. All that sort of sets the stage, I think, for another rate hike in July. And this slower inflation data, I think, gives them the door to, or gives them the leeway to sort of talk about moderating the pace of rate hikes, needing more time to assess that economic landscape that they've been talking about lately. And this will do it. And of course, but keeping rates at these restricted levels will help bring down that level back down to inflation back down to 2% eventually. But, definitely not a rate cut story just yet.
All right, so that's kind of where I think the market's probably trying to go. I think the market's probably discounting, a July rate hike and then, a pause again. The question then becomes, how long is that pause? And is that a 2024 event that we might stay at these levels of rates?
So our first official forecast is just one more rate hike, and that will be it.
Yep.
Again, base case, but then staying at these levels. And so I don't think rate cuts are going to be a story until probably mid 2024. We used to talk about, early 2024 for rate cuts, but now we're thinking a little bit later. And that's because we're also shifting our call for that elusive slowdown again. So now we're looking for more softer growth in around Q4, Q1 now, so around that turn of the year, as opposed to Q3 and Q4. So you just can't argue with the data. It's been very resilient overall. It's, again, difficult to argue with it. So we're pushing out that slowdown a little bit by a quarter.
Yeah, and another thing that you note is that the greenback is struggling a little bit following some of this economic softness, hitting a 14-month low, I believe. To what extent is dollar weakness part of your calculation for what our economy is going to look like in the second half of the year?
The U.S. dollar had been running super strong up until yesterday, and so we're finally going to see that dollar weakness start kicking in, and we're seeing it, and it's also helping because a lot of the other central banks are not yet ready to hit the pause button just yet. Aside from the Bank of Canada, I think that's probably it for the Bank of Canada for the rest of this year. RBA looks like they're almost done, but you've got the ECB and the Bank of England are still going full hog on that rate tightening front. So that's also going to boost so that's also helping their currencies at the same time with the flip side of the weaker greenback.
So can we take the recession talk off the table right now?
Official recession?
Yeah.
It's possible. I mean, we've always been in that soft landing, mild recession, moderate recession camp, but we were never in that hard landing camp. And now, I mean, it is quite possible that we will see, and some people always say, what the heck does that mean? But, no landing. At the very beginning, I used to say hard landing, soft landing, no landing. And it's possible that we could start seeing things glide. And, like nothing is impossible, but this is kind of looking more possible. But at the same time, the longer they leave rates up in that restrictive territory, in order to get CPI back down to 2%, we'll probably need to have that breaking in the economy.
Well, there's the recession for all of us, and then there's the markets, right? And they don't always agree. Do you envision us seeing a little bit more of a risk on trade in the second half of the year after the Fed does potentially start to tone down and soften the rate hike cycle that we're seeing?
We could see, that's a good question. So we could see risk on because of the fact that the Fed is going to start talking about leaving rates as is more firmly, as opposed to talking about needing more time. But at the same time, why are they talking about needing more or staying on hold? It's because the economy is finally starting to slow. And again, this is when you're going to start to see softer data, more starting to talk about that recession again, or at least that soft landing coming into play in the fourth quarter or so. So it's going to be a little bit of a mix. I don't know which one is going to outweigh the other, because again, yes, it's good news for the markets that the Fed's not going to keep tightening, but at the same time, it's bad news because that means that the economy is slowing and it's not needed anymore.
So I guess one of the issues for a lot of investors is just kind of, we think beyond beyond 23 into 24, 25, what kind of economic growth do you think is reasonable for an economy that has dealt with this much inflation?
So we're probably going to see at least some below average, at least for a little while. So we, for this year, we have about 1.7% growth, and that was a little bit higher than we had originally because of this delayed slowdown. But for next year, we've got I think it's a 0.5% growth, which is obviously very sluggish. And then for the year after, we're going to start seeing some improvement as the rate cuts start kicking in. But again, I think we're probably going to see some sub-average growth at least over the next few years.
And where do you think that sub-average growth is going to be the most prevalent in the coming years?
In terms of where, by country or by sector,
like
or?
in terms of demo and geographic.
So I think the U.S. will probably be just again because America's still going to be the strongest with all the different positive fundamental factors behind it. I think the U.S. will still emerge probably stronger than. Emerge at a faster pace, I guess, from this slowdown than everyone else. The areas where I'm going to be a little bit more worried will be Europe and the UK, only because they've already had the other issues that are not related to pandemic, like Brexit, for example. At the same time, you also have higher inflation and higher interest rates staying longer, higher for longer there. And they're still going whole hog on that tightening front. I think the ECB minutes today were alluding to the fact that there are more governing council members from the ECB are thinking about September. I think it's a bit early, but that's something that it's becoming more of a reality, possibly in the next little while.
Jennifer, we also got another initial jobless claims number today, came in better than expected, and showing a decline from last week. Again, just another data point on what is kind of a very solid labor market. What do you make of this labor market? Does this surprise you at all, the strength?
Broadly, no. And then, it's still strong. At the same time, it is starting to soften. That 209,000 increase that we saw in payrolls was still below expected. But like I said before, during any other given year, it's still a very solid number. But I think there are still some other issues that are coming in play, like, again, demographics, people changing retirement patterns, people retiring earlier, people having fewer kids, so and then of course the aging of the global population, all that feeds into tighter labor markets. So this is an issue I think that's going to be playing on for some time. It's not going to be like what we saw earlier, like half a year ago, but at the same time, it's not going to be as loose, I guess, as one would expect. It was interesting. I was looking at the NFIB survey earlier this week, and I was looking at over the past decade, like how they were talking about the single biggest problem that you're reporting. So over the last decade, I think the inflation, of course, it was up and down, but overall it was still pretty modest, being the inflation being the number one problem. But labor market, labor quality was still around.
Yeah, Jennifer, we're gonna have to wrap it up right there just because of time. But we appreciate getting your thoughts. Jennifer Lee, senior economist at BMO Capital Markets. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, automakers and union officials are in Detroit for contract negotiations that started on a less than friendly note. Bloomberg's Gina Cervetti has more.
Steve, the gathering began with a symbolic snub when UAW President Shawn Fain broke decades of tradition by refusing to shake hands with reps from each of the big three car companies. Fain is looking to protect jobs as Ford, GM, and Stellantis increase transitioning to electric vehicles. EVs require fewer parts than cars and trucks with combustion engines. The UAW wants to win back the cost of living increases that workers lost when the Great Recession bankrupted GM and Chrysler.
Thanks, Gina. The former Twitter employee responsible for compensation and benefits is suing Elon Musk and Twitter successor X Corp. Bloomberg's Charlie Pellet reports.
Plaintiff Courtney McMillian says thousands of workers were wrongly denied full severance in the aftermath of Musk's takeover of the company. In a complaint filed in the U.S. District Court for the Northern District of California, McMillian said about 6,000 Twitter employees laid off since November 2022 have not received the benefits they were entitled to under the company's severance plan. Before she was terminated, McMillian worked at Twitter as the head of people experience.
Thanks, Charlie. And shares of PepsiCo are up after the company adjusted estimates once again following a strong quarter, suggesting consumers are still willing to pay.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 10:21 on Wall Street. We check the markets for you all day long here at Bloomberg, and stocks, they are trading higher. Investors reacting to that weaker than expected inflation report on producer prices we got earlier today. On the one hand, we do have signs of strength in the job market because weekly jobless claims, they came in weaker than expected. And the Dow right now, it is up 87 points. That's up about 0.7%. The S&P 500 up 22, about 0.2%. The Nasdaq, it is up 120 points, so it's the big winner of the day in percentage terms, up almost 0.9%. The yield on the 10-year Treasury right now, it is 3.8%. Spot gold, it is trading higher. It's been up about fractionally up about $1.21 right now. NYMEX crude, it is trading higher. It was lower earlier. Right now it's $76.55 a barrel. There is some bearish sentiment on oil. Global oil demand isn't expected to grow as fast this year as previously thought, and that is due to the faltering economies of developed countries, particularly Europe. And this is according to the International Energy Agency. IEA head of Oil Markets Division, Toriel Bassoni.
We're seeing weakness, especially in Europe, and as the manufacturing remains weak, we're also seeing some negative sentiments in China.
And Bassoni there on the Pulse with Francine Lacroix. And you know how many people are still working remotely at this point, and how this is really killing landlords who rent out all that office space? Well, now McKinsey Global Institute says with office attendance at about 30% below pre-pandemic levels, remote work could wipe $800 billion from the value of office buildings in major cities. That's a 26% plunge, guys, from the before times of 2019. And Pollen Medicine McKinsey is warning this could deepen to as much as 42%. Could be a good time, though, to rent office space here in the city if you have a business and you always wished you could afford it. Asking rents in New York City for commercial offices, that's down about 18%. And that, Maddie and Paul, is a Bloomberg Business Flash.
All right, Denise, thank you so much. We appreciate that. As always, Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. Tech Talk today, a good one. We have folks at Huawei Technologies, Steve Geisler, U.S. Chief Intellectual Property Counsel, and Andy Purdy, Huawei USA Chief Security Officer. They joined us for a roundtable on Huawei's 2023 Innovation and IP Forum at its Chinese headquarters today. Steve, before we get to kind of what you guys are doing at your forum today in Shenzhen, China, talk to us, Steve, what it's like at your company dealing with sanctions from the West, particularly the U.S. How has that impacted your business?
So my business, I'm a lawyer within the Huawei corporate family. So for me personally, it means more work. It does, however, mean as an American, I have to always be mindful of the export control and the sanctions laws because I work in intellectual property. That does, of course, put some constraints on me. But by and large, my day-to-day job deals with patents, which are publicly known. Of course, the word patent means open. So I deal with technologies once they've already become public, and I deal a lot with licensing with other companies. And so my day-to-day job is not impacted nearly as much as if I were, say, an engineer working within the Huawei corporate family.
Okay, well, because you're a lawyer, I know that you are not going to answer this question, Stephen, but just to throw it to you, what does Huawei's return to the 5G phone market look like, and what does the smartphone business continue to look like for Huawei given these sanctions?
I will definitely give you the lawyerly answer, but the correct answer. My job really is not to predict it, it's just to prepare. So if Huawei were to return to the 5G phone market, I need to make sure that we have the licenses in place, such as the 5G standard essential patent licenses with our licensing partners to make sure that we would allow for that. Huawei previously did have 5G phones, so we have most of those patent license agreements already in place. So my role in terms of preparation for such a contingency is already underway. But in terms of predicting and in the sales visibility of our product mix, people like Andy certainly can address that. But for me, I prepare. I don't predict.
All right, so
the nature of my job.
So Andy, let's bring you in here. Andy Purdy, Chief Security Officer for Huawei Technologies in the U.S. Talk to us about what you guys are doing with this Innovation and IP Forum in Shenzhen today. What are some of the big products and services you guys are talking about here?
Yeah, this is a part of our bigger effort that you touched on with Steve a moment ago. Given the situation that we face in the United States and around the world, we've been trying to, and we've been successful at adjusting our business strategy and changing our portfolios with a huge historic investment in R&D, over 25% of our global revenues, so that we can customize our products for our carriers, our enterprises, and our consumers. But the three key things of technology that we are embracing that are part of this program today are digitalization, intelligence, and carbon neutrality. So our focus as a company has been on connectivity, computing devices, intelligent auto solutions, and digitalization of power. And you can see that in the example of, we talk about AI, the Pangu AI 3.0 that we're going to be talking about in this conference, which is heavily focused on weather. And the Nature magazine has just issued a major article about weather prediction. It's very exciting about how AI is going to make every industry more productive and efficient, and it's going to reshape all industries with AI. So our focus is really on industry AI.
So Andy, just from the technology standpoint, the commercial standpoint, what are your leaders in China telling you about, kind of their strategy for dealing with the West, whether as customers, as supply chain? What scenario are you operating under? Like, how do you create a 3 to 5 year business plan?
Well, as I said, we're leveraging the convergence of technologies, 5G, cloud, sensor technology, AI, catalyzing the digitalization of industries that we've been working on, and actually moving toward 5.5G, which is some of the other things we're going to be talking about today. So we're heavily investing in what we can do in terms of develop technologies to help the telecom carriers raise their capabilities to supply 5G and hopefully 5.5G, and to help the customers of the industry sectors around the world, such as you can see the benefits of the Pangu 3.0.
So given that, I'm curious if this kind of overall push into IP licensing, does that mean that your focus is more on back-end technology versus more consumer-facing products?
Steve, you may want to touch on this also, but no, it's the smartphone issue has been what was dramatically affected the inability of American companies to sell the non-sensitive 5G tech, the 5G chips for our phones. So everything else we've been emphasizing with the digitalization, and we've been able to grow our enterprise business by 30% in 2022 using the themes of digitalization and digital transformation. We've leveled off the drop in our consumer business, and we expect our carrier business to meet expectations.
Steve, do you have any thoughts there as to kind of how you guys are navigating some of from a patent perspective?
Yeah, so as Andy said, the IP actually is somewhat detached. Now, it's not completely detached. We typically are going to be patenting the same technologies that would be in our product mix. However, just because we don't sell a product in the United States does not mean we're not going to get a U.S. patent. So, for instance, as of the end of last year, we had 120,000 patents globally that were active, including about 22,000 active U.S. patents. We had about 40,000 Chinese and European patents each at the end of last year. But in terms of the patenting, we just, for instance, Wi-Fi 6, which is the new version of Wi-Fi that is now being commercialized, that's out on the market. Huawei has about 20% of the standard essential patents that would be used when someone is making, using, or selling a Wi-Fi 6 enabled product.
Yeah.
So that is the type of R&D that, as Andy said, we actually have increased R&D funding up to $23 billion last year alone.
Right.
And so Huawei has no choice but to continue to innovate and still has product sales. However, those product sales geographically, the footprint has changed since 5 years ago. And also the product mix, there's a different focus for within various industries.
Andy, in our final minute with you here, given what Stephen was just talking about with ideation and R&D, what do your plans look like for 5G chip procurement domestically in China?
Well, we have been continuing to emphasize the diversification of our portfolio, of our supply chain, so that we can meet the needs of our customers. I don't have any comment yet on the explosion of news stories on what you're talking about, but we are proceeding on the assumption that we have certain limitations, and we're going to continue to grow our businesses in other areas, such as smart mining, smart roads, smart ports, electric power, railway, and moving into 5.5G, which is very exciting. Frankly, when you talk about the one piece of technology innovation, our leaders, Ken Hu, our vice chairman, has estimated, we look at AI, that 98% of all AI is going to be industry and some agriculture, and only 2% is consumer. And the focus recently has been on consumer, the generative AI. But it's going to be much more important than that to the world.
All right, Andy, thank you so much for joining us. Andy Purdy, Chief Security Officer for Huawei Technologies, and Steve Geisler, U.S. Chief Intellectual Property Counsel. And I know both of these gentlemen got their law degrees from the University of Virginia, so wahoo wah. So good stuff there. Appreciate talking to you about Huawei and the world of tech. Markets, they are higher. S&P 500 up 0.5%. Right now, let's head down to Washington, D.C., world and national news with Nathan Hager.
Breaking news out of Pittsburgh, Paul. A federal jury has found the man behind the deadliest anti-Semitic attack in U.S. history eligible for the death penalty. Prosecutors are seeking capital punishment against Robert Bowers. He gunned down 11 worshipers at the Tree of Life Synagogue in 2018. Today's verdict sets the stage for even further evidence and testimony on whether that 50-year-old truck driver should face death or life in prison. The Food and Drug Administration has approved the first over-the-counter birth control pill. Perrigo's once-a-day O pill can now be sold without a prescription. The company says it will start shipping it early next year, and there will be no age restrictions. Hollywood is bracing for its first industry-wide strike since Ronald Reagan was president of the Screen Actors Guild. Negotiators with SAG-AFTRA unanimously recommended a strike last night. After 4 weeks of negotiations with producers, Matt Damon says it's important to protect actors who aren't household names like him.
$26,000 a year is what you have to make to get your health insurance, and there are a lot of people who residual payments are what carry them across that threshold.
The union is going to meet again at noon Wall Street time for a final strike vote. Actors could pick up picket signs as soon as today. President Biden is taking his NATO victory lap to the alliance's newest member state of Finland. He met with Finnish leader Sauli Niinisto and said his country will be an incredible asset to NATO and the world.
And the main reason is we have the same value set. I really mean that. It really matters.
And the president's also meeting with leaders of other Nordic nations before he heads back to Washington tonight. In Ukraine, they are surveying the damage after air defenses shot down 20 Iranian-made drones fired by Russia overnight, mostly in the Kiev region. Officials say the wreckage sent 2 people to the hospital. Several homes were destroyed, high-rise apartments damaged. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And we do have another mini rally going on today for stocks. It is 10:40 on Wall Street. I'm Denise Pellegrini. We check the markets all day long for you here on Bloomberg, and stocks are broadly higher after a report on producer prices for June showed inflation easing. The Dow right now up 90 points, about 0.3%. The S&P 500 up 24 points, that is about 0.5%. The Nasdaq, the big winner of the day, once again up 128 points, just about 0.9%. Amazon, one of the leaders today, shares up more than 1.5%. Adobe says U.S. shoppers spent almost $13 billion online during Amazon's 48-hour Prime Day. That was up more than 6% from a year ago, but still, I should also mention the expectation had been for 9.5%. And checking on Treasury markets right now, the yield on the 10-year, it is 3.8%. The dollar also in focus, getting a little bit more expensive to travel overseas as the dollar weakens. Dollar weakening as a growing number of investors think the Fed is maybe approaching the end of its rate hike cycle. But maybe just postpone that overseas trip. Don't give up entirely, because Bloomberg's David Finnerty says the dollar, it could end up strengthening again soon because
if the pound or the euro, which are two big weightings in the dollar index and the Bloomberg dollar index, if they were to start faltering, the dollar by default would start gaining. So I think the question becomes there is not only will the BOE hike or ECB hike, that's sort of guaranteed and expected, is how will the economies react to that? If those economies are forced into a recession, then and the US economy doesn't go into recession, then you could actually see sterling and euro coming under pressure, which would help the dollar by default.
Right, so Finnerty's saying there, watch for the dollar to possibly strengthen again from here. And another fight between Twitter and former employees. The former Twitter employee responsible for compensation and benefits at the social media platform suing Elon Musk and Twitter's successor X Corp. Now, this suit says thousands of workers were wrongly denied full severance after Musk took over the company. And Paul and Maddie, in response to Bloomberg Law's emailed request for comments, guys, Twitter sent us an automated poop emoji.
Oh my God, no they didn't.
I have never, ever seen that. But I got to say, we're number one here at Bloomberg, and that is a Bloomberg Business Flash.
Whoa.
All right, very
That was a great
interesting.
flash. I was plugged into that Twitter news, Denise Pellegrini.
Yeah, the poop emoji. That's class. All right, let's check in on these markets here today. S&P 500 up 0.5%. We got another confirming inflation detail today. The inflation is, in fact, coming down. Michael Cugino joins us. He's a president and portfolio manager at the Permanent Portfolio family of funds. So, Michael, we're seeming to getting more and more data points that are confirming that inflation is, in fact, in decline, getting closer to the Fed's target. How does that kind of factor in with how you're thinking about your funds and kind of how you're allocating capital?
Well, we are balanced in the middle. We're allocating money towards precious metals, gold and silver, for example, U.S. and non-U.S. equities, and U.S. and non-U.S. bonds, real estate investment trusts, which have been really undervalued, and some of the commodity space, energy, and some of the the base material commodities. So we're driving down the middle, so to speak, because in our view, there's still too much of the unknowns out there to really predict how things are going to go. We see a bifurcated market between bond and equity investors, and they both can't be right. On the bond side, you got an inverted yield curve. It's looking more bond investors look like they're expecting a recession at some point. Equity investors, equities are bleeding up despite declining earnings and despite, some other indications of maybe tightening financial conditions. Both can't be right over the long term, but in the short term, we have a bifurcated market.
Okay, so given that, and you mentioned T-bills, are you thinking any differently now about duration here? Are you thinking still very short T-bills at the moment, or are you looking more duration?
Well, we are still relatively short. Our durations across our products on the bond side are probably under 3 years. And so that's the longer end of the short space and the beginning of the intermediate space, I guess. And that would be based on the fact that, again, there's too many unknowns. So we don't think you're being compensated properly risk-reward going out too long. But like any bond investor, if you're getting near the end of a tightening cycle and you may have stable rates or declining rates, you're going to want to be looking at duration and probably extending. So there's a real tightrope you got to walk there right now. And like everybody else, I think we're doing that. We haven't extended duration yet. We're staying still high-quality balance sheets because we are concerned about tightening financial conditions. But we are looking at duration actively and considering how and when and to what degree we might want to lengthen.
Michael, I'm interested with your commodities caller. You mentioned gold here. It's had a nice run this year. How much more do you think has to go for gold?
Well, I think, again, it's based on, while the inflation is declining, you do have a lot of deficit spending. You do have a lot of geopolitical uncertainty. You have some question on the financial system. And if we do get a recession, what that will do. And gold tends to perform pretty well in recessions because it's likely that the Fed moves to cut interest rates to offset that. And that would be a benefit or a tailwind to gold. In addition, you've got a lot of central banks that, generally speaking, have been buying around the world. You got the longer-term, broader macro issues of an active campaign to possibly replace the U.S. dollar as a reserve currency, which, is always a risk out there. But you've had more and more countries expressing that desire and working together. And, in fact, some global transactions have been settled in currencies other than dollars. And that could be catastrophic for the U.S. and our financial condition and our ability to basically change the way we do business in the United States. If that were to ever come to play, and I'm not predicting that, but the risks are higher there, and gold would be an offset to that as well.
Do you feel like you're more interested in gold and some of the other asset classes that we've talked about because of the narrow rally that we're currently seeing and kind of the breadth in that rally?
I would say we view gold as a necessary component of broad financial planning and broad wealth creation. And so we're always fans of it because it has benefits that traditional asset classes like stocks and bonds do not have. That doesn't mean you want to, unless you're a trader, you're not throwing all your assets behind it. We certainly don't. But we do have a healthy allocation. And I don't know where we would stack up against others, but yes, I think given the landscape that we see out there, broadly speaking, we do think it's healthy to own gold, and in fact, we're slightly overweight our target.
You mentioned energy, and that had such a great run over the last couple of years. A lot of folks are wondering if that's played out. I say that we got WTI crude up again today at just under $77 per barrel. So, what's your energy call at this point?
Well, we like it long term. I mean, energy had a real good last couple of years, although this year, up until recently, it's performed really not that well at all. But in the long term, we like it. I mean, our belief, and I think of many, but not everybody, is that while we're moving towards more efficient, environmental energy sources that are better for the planet, there's absolutely no way that given existing technology, the green energy options out there right now can cover global energy demand. They just can't, and it's a pipe dream to assume otherwise. And so we think that energy, fossil fuel is going to be with us for a while, whether it's natural gas, whether it's oil. While they may decline gradually, they're going to be there for a while. There's been a lot of underinvestment in that sector over the last decade. There's some catch-up going on in the last couple of years. Demand was anemic because global growth was slow, and the dollar was strong, which was a big headwind towards the price of oil over the last roughly decade. And so we think over the long term, those conditions are going to reverse. We think demand will pick up eventually. We think that, supply may have trouble meeting that. Then you have political issues like what OPEC may or may not do, and or others, and U.S. production, which, may increase or not. And so there's some variables out there that would impact the price as well.
Right.
And so, it's performed really, really well the last couple of weeks.
All right, Michael.
We expect broadly it's going to continue.
All right, Michael, thank you so much. We appreciate it. Michael Cugino, President, PM, a Permanent Portfolio Family of Funds. We're going to go to Finland right now. President Biden is speaking with the President of Finland, a press conference. He's taking some questions right now, so let's go to Finland.
Prevent the U.S. presidents in the future from withdrawing from NATO without Senate's approval. What actions?
Sorry, without what? I'm sorry? I didn't hear the last part of your question.
In Washington, a bipartisan group of senators has repeatedly failed to pass through Senate a law that would prevent future US presidents from withdrawing from NATO without Senate's approval. What actions will you take to assure Finland that US will remain a reliable NATO partner for decades to come?
I absolutely guarantee it. There is no question. There's overwhelming support from the American people. There's overwhelming support from the members of the Congress, both House and Senate, in both parties, notwithstanding the fact there's some extreme elements of one party. We will stand together. The American people known since the end of World War II and the formation of NATO that our security rests in the unanimity among European and transatlantic partner, us. And so this is, no one can guarantee the future, but this is the best bet anyone could make.
And my second question on that note to Mr. President Niinistö, hearing this answer that no one can guarantee a future, are you worried that the political instability in US will cause issues in the alliance in the future?
Let me be clear, I didn't say we couldn't guarantee the future. You can't tell me whether you're going to be able to go home tonight. No one can be sure what they're going to do. I'm saying as sure as anything can possibly be said about American foreign policy, we will stay connected to NATO. Connected to NATO beginning, middle, and end. We're a transatlantic partnership. That's what I've said.
It seems that the President has answered your problems, but I have to tell you that during this process, I met approximately President many times, but I would say about 50 people from Congress and Senate. And I think the message was quite clear, quite united. And I have no reason to doubt about USA policies in the future.
Let me say one more thing. We learned a hard lesson. Peace and security in Europe is essential to U.S. security and peace. The idea that there could be conflict in Europe among our friends and us not engaged has never happened in modern history. That's why we're staying together.
Next question, President Biden.
Oh, I've called on somebody, I'm sorry. Wall Street Journal, Andrew?
Thank you, Mr. President. You've said that Ukraine shouldn't enter NATO until after the war is over. Are you concerned that all of those comments could motivate Putin to keep the war going or discourage him from entering peace negotiations? And is there a serious risk that this war could drag on for years? And do you see any path toward the war ending with Putin still in power?
First of all, no one can join NATO while a war is going on, where a NATO nation is being attacked, because that guarantees that we're in a war, and we're in a third world war. So that it's not about whether or not they should or shouldn't join, it's about when they can join, and they will join NATO. The issue of whether or not it's going to keep Putin from continuing to fight, the answer is Putin's already lost the war. Putin has a real problem. How does he move from here? What does he do? And so the idea that there's going to be what vehicle is used, he could end the war tomorrow. He could just say, I'm out. But what agreement is ultimately reached depends upon Putin and what he decides to do. But there is no possibility of him winning the war in Ukraine. He's already lost that war. Imagine anyway, he's already lost that war.
Just on the question of a concern about it going on for years, is there a possibility that there's a stalemate and this becomes...
I'm sorry?
The question of whether the war could go on for years, is there a possibility there's a stalemate and it can continue for quite some time?
Well, I don't think the war can go on for years for two reasons. Number one, I don't think that that Russia could maintain the war forever, number one, in terms of their resources and capacity. Number two, I think that there is going to be a circumstance where eventually President Putin is going to decide it's not in the interest of Russia, economically, politically, or otherwise, to continue this war. But I can't predict exactly how that happens. My hope is, and my expectation is, you'll see that Ukraine makes significant progress on their offensive, and that it generates a negotiated settlement somewhere along the line.
And I have a question for the Finnish president, but I would be remiss if I didn't raise my colleague Evan Gershkovich, who's been in prison for more than 100 days. And I just wondered if you had an update on the process for trying to get him out of prison, and if you're serious about a prisoner exchange.
Well, I'm serious about prisoner exchange. I'm serious about doing all we can to free Americans who are being illegally held in Russia or anywhere else for that matter. And that process is underway.
Like I told, we are discussing on DCA, the Defense Cooperation Agreement, and it has a lot of elements. They are still open, but we are open on negotiations, and I know that our counterpart is also very open. So let us see.
Next question goes to President Niinistö, please.
Yes, it's Helsingin Sanomat and Elina Antonen.
Thank you, Mr. President. And my question is for Mr. President Biden.
Okay.
Or should I just say President Biden? You have repeatedly talked about Finlandization becoming NATOization of Finland. Now, based on
Sorry, as what nation?
You have repeatedly talked about Finlandization
becoming
NATOization of Finland. Based on your long experience, how does that change Finland's place in the world?
Well, first of all, the context in which I said that was the gentleman who occupies a seat on the other side of your border in Moscow said he wanted the Findalization of NATO. I said it was more likely to get the NATOization of Finland. That's the context in which that was said. And what was the second part of your question?
I asked, how has Finland's position in the world changed during this NATO membership process?
Finland's already a strong, vibrant nation. I think what Finland's joining NATO does, and Sweden as well, when the Nordic countries are all members of NATO, just makes the world safer. It significantly increases the prospect that there is less likely to be war. We're deadly earnest about the notion. We'll defend every single inch of NATO territory. And now we're on the way of getting to 32 NATO nations. That's a significant commitment. And so the likelihood of any nation voluntarily deciding they're going to attack one of the nations or Finland is highly unlikely. And so, but if it were to, they understand they're not just attacking Finland, they're attacking 31 other countries.
Next question, President Biden, please.
Oh, I'm sorry. I guess it's Arlette, CNN.
Thank you, Mr. President. We've seen more disarray with Russian generals, most recently with the firing of a general who criticized the defense ministry, this following that rebellion by Prigozhin. Does this raise any new concerns about Putin potentially doing more drastic things regarding Ukraine, like nuclear weapons, or potentially against the U.S., like election interference?
Well, first of all, they're already interfered in American elections, so that would not be anything new. They did that last time they tried to. But with regard to, I don't think there's any real prospect, you never know, but of Putin using nuclear weapons. Not only has the West, but China and the rest of the world has said, don't go there. Don't go there. Number two. Number three, I think that determining what happens to Prigozhin, what happens to what happens when we discuss this in Vilnius, is God only knows what he's likely to do. I'm not even sure, we're not even sure where he is and what relationship he has. If I were he, I'd be careful what I ate. I'd be keeping my eye on my menu. But all kidding aside, who knows? I don't know. I don't think any of us know for certain what the future of Prigozhin is in Russia. And so I don't know how to answer that question beyond that.
And if I could also ask you something about happening back home, you're seeing the GOP grappling with tying abortion rights to defense issues, including a block on military promotions by Senator Tuberville. What does this say about U.S. military readiness? And would you be willing to talk with Tuberville to try to work out some solution?
I'd be willing to talk to him if I thought there was any possibility of him changing this ridiculous position he has. He's jeopardizing U.S. security by what he's doing. I expect the Republican Party to stand up, and do something about it. They've in their power to do that. The idea that we don't have a chairman of the Joint Chiefs of Staff, the idea that we have all these promotions that are in abeyance right now, that we don't know what's going to happen, the idea that we're injecting into fundamental foreign policy decisions what in fact as a domestic social debate on social issues is bizarre. I don't ever recall that happening, ever. And it's just totally irresponsible in my view. And I just think that, I'm confident that the mainstream of the Republican Party no longer does not support what he's doing. But they got to stand up and be counted. That's how it ends.
And for President Niinisto, you've been working on fortifying the fence along the border between Finland and Russia. Is there anything that you're seeing recently that concerns you? And also, as a leader who shares a border with Russia, what more do you want to see done to deter Putin?
During the beginning of our application process, surely we had to make sure first trying to figure out every possible negative action we might meet, and surely how we respond on that. And we were very careful on that work. So at the moment situation is quite calm. Hope it remains as such. But I just want to tell you that Finnish people do feel more secure at the moment. We have 80% of population supporting NATO membership, and more than 80% who say that we will also protect our allies. That's the Finnish position.
Thank you. This concludes the press conference.
Thank you very much.
All right, that was President Biden and the President of Finland with a joint press conference in Finland after a day of meetings between the two presidents, and Finland coming into NATO. So a momentous day there for Finland, for the United States, and for the North Atlantic Treaty Organization. Right now, let's get what are we going to do? Let's get a business flash. We're going to get a business flash. Who are we going to do that with?
Hey, Paul.
All right, let's do Denise Pellegrini. There we go.
Yeah.
Thank you.
Here I am on the other side of the column. It is 11:03 on Wall Street, and we check the markets all day long for you here on Bloomberg Radio with Paul and Maddie this hour. We do have another sign that inflation is easing. U.S. producer prices rose at the slowest pace in nearly 3 years. The producer price index for final demand rose just 0.1% from a year earlier. But, and you know there's always a but, on the other hand, a report on first-time jobless claims showed fewer people than expected filed for those unemployment claims, and that does show possible continued strength in the labor market. And Torsten Slok, chief economist at Apollo, says inflation easing a bit does mean the Fed will start to shift its focus.
It's all about the dual mandate. That for a long, long time they've been focusing on the inflation part of the dual mandate because it was very clear that inflation was and still is at levels that are too high for their comfort. I do think that the narrative, both for the Fed and also for markets, will now begin to change towards growth or towards employment. In other words, what are the reasons why we're still having this strong economy. And if the lagged effects of monetary policy that they have spoken about for so long, where it takes 12 to 18 months to slow the economy down, well, the lagged effects of Fed hikes will eventually begin to slow things down. We're already seeing that across all indicators, and we should expect that also to happen over the coming quarters.
And Slock with us there on Bloomberg Radio and Television. Stocks, as I mentioned, are higher. The Dow up 71 points now, about 0.2%. The S&P 500 up 26, 0.6%. The Nasdaq up a whopping 147. That's more than 1%. The yield on the 10-year Treasury 3.81, let's call it, percent right now. Crude oil right now, it's up slightly, up at $76.50 a barrel. And spot gold right now, it is also higher. Delta Airlines shares soaring, some strength in the air there. Delta sees global travel pushing summer profit past estimates. And we're learning now that Cargill is behind that big cocoa trade that's been rattling the London market that we've been telling you about. The world's largest agricultural trader, been building a dominant market position there. Now that trade comes after 2 years of shortages in chocolate. And forget Goldfinger, they're calling this one, guys, Chalk Finger event, with Cargill basically cornering the market. And it all means, unfortunately, you'll be paying more for that chocolate bar and your chocolate mousse and also your holiday candy this year. So if you're not watching what you eat, as we just heard President Biden say, apparently jokingly, that Putin from Russia should be doing, you're going to be bummed out when your chocolate is more expensive. And that is a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate that. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker studio, and of course streaming live on YouTube. Just head over to YouTube and search Bloomberg Global News. And we are joined, Maddie, this hour with none other than Barry Ritholtz. He's got a little podcast known as Masters in Business here at Bloomberg, and he also runs a couple shekels over at Ritholtz Wealth Management. Barry, thanks so much for joining us here.
Thanks so much for having me.
Who's on the podcast this week?
Tom Wagner. He is the co-founder and CIO of the $10 billion Knighthead Capital, which is a distressed asset and turnaround investor. And lately, he's been making news because he's been doing these fascinating sports investments with his friend and co-investor, Tom Brady.
Oh.
They bought a pickleball team. They bought Birmingham United in the British Football League. They bought an endurance auto racing team. They've really looked at sports as the next great entertainment franchise, especially away from the major sports. There's a lot of action out there.
And meanwhile, Disney's thinking about what do we do with ESPN? Again, spin out, sell it, merge. It's just a whole bunch. So
giant moneymaker for Disney.
Yeah, it used to be, and now it's a little bit of an issue with the cord cutting. All right, let's get to these markets right here. Green on the screen, Jess Metton. She covers all the equity stuff for Bloomberg News. She joins us here on our Bloomberg Interactive Broker Studio. Jess, what are you looking at?
So I have to bring up what's happening with the CPI-PPI spread, because that's a key gauge when not only are you looking at, obviously, producer prices. We've talked a lot about that this morning, about how they rose at the slowest pace in nearly 3 years. But I started writing about the CPI-PPI spread at the end of last year, and your good friends, Gina Martin Adams over at Bloomberg Intelligence, they're the ones crunching these numbers. So it actually had turned into positive territory for the first time in 2 years back in December. And so that really led the way if you were looking at what that means for input prices, especially for businesses, and typically that'll filter in through there for that improvement before they actually go to consumer prices. So if you were looking at that indicator back at the time, potentially if you fast forwarded, you could kind of see where we're at now as far as where inflation has obviously improved, but really that was telling you that that was going to help boost those profit margins, and especially when you're seeing consumer prices rising more quickly than when you're looking at producer prices. But that is a pivotal shift there as far as a signal of how corporate margins, potentially the worst is past when you're looking at Gina's data from Bloomberg Intelligence, and that typically fuels stronger gains. The question there being, though, after a strong first half, how much of that could potentially already be priced in. But I was talking to Michael Casper, who's also on Gina's team, and he still thinks the worst of the pain is already passed, so that still could support stock prices in the second half of the year.
So I wonder, I know everyone's focused on bank earnings tomorrow, but I'm also curious about the NASDAQ rebalancing, Jess, and I know that you and your sources talk about this quite a lot. What are you thinking about that?
Well, Chris Harvey over at Wells Fargo, who's definitely been on the bearish side and continues to be bearish, his team was arguing that with the rebalance, they're saying that would hit the biggest names in the index, but you have a lot of other people who aren't on the sell side of strategists and arguing that they still don't think that that's likely going to happen, but that rebalance is actually going to happen next Friday. So that'll be a key indication. This is a very special instance of that happening, but you do still have sell side, some of those still on the bearish side of things, but Chris Harvey in particular has kind of been calling it wrong over the past year. So it is a question about whether or not it'll actually happen.
I love to hear from people who've gotten it wrong.
Yeah.
And what I really want to hear from them is, why has our model or why has our process been wrong?
Right.
And, at a certain point, late or early is the same as wrong.
Yeah.
And so I'm perplexed. I have to be honest. I have looked at all the criticism of, the market is too concentrated. The indexes are too concentrated. I think that's the wrong way to approach it. I want to ask people, from the morning you wake up till you put your head on the pillow at night, every single thing you do is driven by technology. Wait, the tech sector is 29% of the S&P 500? How come it's not more? How come it's not 40 or 50%? You can't do any. Even go for a walk in the woods, and guess what? The shoes you're wearing were designed on a computer. They were shipped by a logistical company that relies on technology. You probably ordered them online. There's no escaping technology. It's every part of our lives.
Yeah, I actually wrote a weekend piece about
I'm
that,
sure
about
you-
the health of when it comes to technology. I just sent it to Barry so you can take a look at that, but it kind of goes with what you're saying
All right.
with your argument.
Jess Metton, thank you so much for joining us. Jess Metton, she does it all. She's on radio, she's on TV, and by the way, she is a reporter for Bloomberg News, writing stuff all the time. We appreciate that. All right, coming up, let's take a look at the auto business. But this time, it's not like what's the new car coming out that Barry can opine on, or Matt Miller will burst into the studio and talk about. We're talking about they might have some strike issues with their workers there. Kriti Gupta joins us. She is the host of Bloomberg Surveillance Early Edition of Bloomberg News. So, Kriti, what's happening with the automakers and the workers?
Yeah, well, look, this is my latest obsession. As you guys know, I jump from story to story and really dive in. So this is my latest one. Look, unions are going on strike, negotiations across the country. Today, you are seeing the United Auto Workers, which represents about 150,000 workers in Detroit and across the country, going into negotiations with the big three car makers, General Motors, Ford, Stellantis, and they're basically going to say, we need more money because inflation is high and it's sticking around. And this is a really big deal because it's coming right off on the heels of UPS and Teamsters and those negotiations, making some progress and then kind of collapsing. We, of course, also have Hollywood on strike as well. The actors now kind of banding together with the screenwriters. I think Bob Iger on CNBC said they're making things really tough for the studios. Well, yeah, obviously. So that is kind of the takeaway here. People are really kind of struggling to keep up with inflation, and they're going to bat. Now, the market read-through is interesting here because Bank of America actually quantified this, and they said if the United Auto Workers do eventually go on strike, their contract ends September 14th, and already the president, Sean Fain, is saying, we're willing to go on strike. Don't question us. It's going to cost these automakers billions of dollars that they just don't have.
So that was going to be my question because Vanity Fair had this exclusive story about how studios are willing to wait until writers can't afford their apartments anymore and give up on the strike. So I'm curious what the read-through of that situation is to a General Motors, to a Ford. It sounds like they can't afford to lose out on their workers until they give in and say, we actually don't have the money to continue striking here.
Yeah, well, it's kind of a game of chicken, isn't it? Who is able to tap out first at the end of the day? For the Hollywood writers, I think it's a different story because a lot of the screenwriters, they're not necessarily on, they work freelance. They're contractors at the end of the day. They're not working on kind of a salary or even like an hourly wage. In the industrial space, when it comes to UPS and Teamsters, a lot of these automakers, it is an hourly wage. And it's actually a big difference between the full-time wage and the part-time wage. And so it's a little easier, I think, to enforce on that front. What's interesting to me is that this is so tradable here because they are willing to say, we will walk out because you're trying to scale up your manufacturing right now. We hear this all the time. General Motors and Ford trying to compete with the likes of Tesla, for example. Matt Miller's ears are ringing somewhere. But to do that, you need people at the end of the day. So they have a lot more bargaining power. And this union is really special because They just made some progress with John Deere about 2 years ago in kind of implementing some of their wage increases. And plus, they've already been on strike in 2019 for about 6 weeks. So they've gone through this whole thing. They're willing to walk out. They have a demonstrated kind of track record of doing so. And by the way, during that 6-week period, those car maker stocks took a beating. So there is very real money here. It's very tradable from an investor perspective, but also they have some weight behind them, especially when UPS and Teamsters is setting this tone of kind of go big or go home.
Really, really quite fascinating. What ends up happening as more and more of these auto manufacturing plants become that much more automated and roboticized? How many bodies do they need? If you look at some of the newer Tesla factories, they really are low human, high technology shops.
Yeah, but not always profitable. And I think that's the key piece. When you try to automate, that takes a lot of money and it takes a lot of manpower to get that. And even the fewer people you need on the ground then end up costing more to deal with all the automation. So there is that piece of it. But I completely agree. And I think demographically, you're kind of seeing that switch. You saw it in DHL, you saw it in UPS, FedEx are all trying to limit their human workers, really emphasize the automation. What I'll say on that, though, as well, is when you look at how some of these car makers are actually functioning, one of the, I want to say, pieces that a lot of these car makers have kind of in their back pocket is inflation is coming down. So if your argument here is inflation's high, we need more to kind of make up for inflation and have our real wages show up in a bigger way, well, inflation is coming down and you're trying to lock in a contract that's going to last 4-5 years.
Right.
So they don't have as much perhaps negotiating power as before.
Critty, how much has the previous shortfall of semiconductors been affected automakers? Have they caught up? Is there still, because I know a lot of cars you go to order and it's 6 months to a year out. Are we still dealing with the hangover from the pandemic lockdown?
We're not dealing in terms of their regular production. Where you have the issue is simply this idea of scaling up, because you're not just scaling up your regular kind of gas cars, which will require more chips as a function of that, but you're scaling up EVs, which require even more chips. And so it's the scaling up that's the issue at a time when the Biden administration is actively making it tougher to actually source some of those chips from Taiwan and elsewhere. So it's not an issue at the moment, but it could be an issue in a couple of years when you start to see a lot of the domestic chips cost a lot more money because they are made stateside.
All right, Kriti Gupta, thank you so much. We appreciate it. Kriti Gupta, she's the host of Bloomberg Surveillance Early Edition. She's also doing some work here on this automaker news. I mean, a strike would not be good. I mean, think about they haven't had the last strike with the UAW was in 2019. Where 50,000 employees from GM, and that lasted 6 weeks. So
That's
that
a
would
long
not be
time.
good. I mean, you just came through the pandemic. You've still got supply chain issues. Things are starting to crank now. You're making a transition to EVs. Just another example. They got to work things out, and even more so. You mentioned the writer strike. I mean, Jesus. I mean, I don't know how they allocate the equities there. So we'll have to keep an eye on that.
You know, it's not a coincidence that you end up with.
All right, let's get some company news with Steve Rappaport.
Paul, we had shares of Delta hitting a 2-year high after topping expectations and raising its full-year guidance. Earlier, we heard from Bloomberg intelligence analyst George Ferguson. He predicts that growth will continue into the third quarter, noting that some of that was already baked in. But the question now, will it roll into the fourth quarter of this year and Q1 in 2024? Hollywood is bracing for a shutdown as actors say contract talks with studios have collapsed. What's going on with that? Is the big issue streaming royalties from streaming platforms. Here's the deal. The actors are saying they want a bump in pay that is commensurate with a show's success. The studios are saying, whoa, hold on a second. We don't know how this is going to go because they argue those platforms have yet to make a profit. So if the actors do walk off the job in joining Hollywood writers, that would be the first time that Hollywood has a simultaneous strike since in 63 years. So we're watching that closely. And we have big numbers out of Amazon. They were up after the company reported record sales during its Prime Day promotion. Paul, what'd you buy?
Oh, I can't mention it on air.
All right. Well, I ended up buying one of those ring. Vacuum? Which one?
Dyson.
Ooh,
I had
Dyson.
To splurge. I'm almost 30. Yeah,
Fancy.
It's time.
Very good stuff. Yeah, I ended up with a Ring doorbell. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Hada Labo Lotion is #1 lotion.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 11:20 on Wall Street. We check the markets for you all day long here at Bloomberg. We do have a mini rally going. Stocks are higher. Investors reacting to that weakening inflation in the form of that report today we got on producer prices. Now, on the other hand, we do have some signs of strength, and that's in the labor market. Weekly jobless claims, they came in weaker than expected. And the Dow, the S&P, and the NASDAQ, they are all higher. The yield on the 10-year Treasury right now, let's call it 3.8%. Spot gold also higher. NYMEX crude, it is higher. It's been hovering just around the $76+ a barrel for most of the day. We do have some bearish sentiment on oil longer term, though. Global oil demand, guys, isn't expected to grow as fast this year as previously thought, and that is due to the faltering economies of developed nations, according to the International Energy Agency. And here's how IEA Head of Oil Markets Division Tariel Bassoni puts it.
We're seeing weakness, especially in Europe, and as the manufacturing remains weak, we're also seeing some negative sentiments in China.
And Bassoni there on the pulse with Francine Lacroix. And you know how so many people are working remotely, even if it's just maybe coming into the office a couple days a week? Well, of course, all this has, far fewer people showing up in office, and demand for office space is really faltering. And now McKinsey Global Institute says with office attendance at just about 30% below pre-pandemic levels, remote work could actually wipe out some $800 billion from the value of office space globally. That would be a 26% plunge. Could be a good time, though, to rent space, because office space in New York City, it's way cheaper than it used to be. And that is a Bloomberg Business Flash.
Denise Pellegrini, thank you so much. We appreciate it. Madison Mills, Barry Ritholtz, and Paul Sweeney here in our Bloomberg Interactive studio. We got it covered. And we're welcoming Randy Schwimmer into the studio as well. Always love chatting with Randy. He's co-head of senior lending, and he's the senior managing director at Churchill Asset Management. Randy, one of the many reasons we love speaking to you, because you're an expert in this private credit business out there, which has been such a hot market, getting lots of capital, and has really become a big part of the capital markets, really past since the great financial crisis. How is your business today in what appears to be a market that is seeing inflation moderate, maybe taking the recession story off the table a little bit? How's that? How are you seeing that in your business of directly lending?
Yeah, first of all, thanks again for having me on. So I did some homework just for you, Paul. So looked for the first half numbers for our business to sort of get a sense for how we're doing. Turns out, and we have a senior debt business and a junior capital business, all under the Churchill banner. We did 175 deals in the first half of the year. Okay,
really,
$5 billion across those two platforms, right? So I was like, whoa.
How big is your firm, by the way?
So we're like total committed capital of about $46 billion. And then you throw our Arcmont sister company in Europe, they're another 25 billion. So, but the thing that surprised me a little bit is that despite a lot of the softness in M&A that we saw in the first half, what's driving our deal flow is the kind of migration from public credit to private credit, because the banks have been a bit offline with some of the liquid loans. They don't have clearing price. They don't have CLO formation. A lot of the cash is coming out of retail funds, not going in. And so they're a bit offline, and so a lot of that activity has come to the direct lenders, so that's helping us. And then we have the scale. We can commit, $400 or $500 million per deal and get stuff done. So those combination of things makes it right now pretty attractive.
So back when the Fed was at 0 and the 10-year wasn't even at 2%, the demand for private credit from investors was very high because a huge premium with not a whole lot more risk for better returns. Now that you could get 5% plus on corporates and munis are not that far behind, how does that affect your investor base? What are they looking at in the world of private credit as an asset class?
So Barry, that's exactly the question that comes up at these investor meetings. And the answer is that the opportunity in private debt is not necessarily a timing thing, because to your point, it was very attractive 2 years ago. It's more attractive from a pure yield perspective today still relative to corporates. The question is, how long will that attractive corporate and high yield bond trade last? If what Paul says is true, we're starting to see a little softening in the numbers, which we saw today, and it looks like the Fed might, maybe they raise once more, maybe it's once and done, then at some point rates are going to start to come down. What's going to happen for investors who are looking for long-term income streams is they're going to see those corporate bond rates start to come back down again. And eventually, whether it goes back down to where bonds were kind of 3 and 4%, the way they were two years ago,